Good morning, good afternoon, or good evening, depending upon where you are in the world, and welcome to our discussion about gain a 360-degree view of risk, making effective data management an integral part of your compliance strategy. I'm Chris Keach, and I'll be your moderator today. We have just a few brief announcements before we begin. First, the slides will advance automatically throughout the event. You may also download a copy of the slides by clicking on the green folder icon located at the bottom of your screen. You can participate in our Q&A session by asking questions at any time during this webinar. Just type your question into the Q&A text area, and we'll be glad to answer any questions that you have. We also recommend at this time that you disable your computer's pop-up blockers. This will allow the slides to advance automatically throughout the event. If you're experiencing any technical problems, please type your issue into the Q&A text area, and we will be glad to offer one-on-one assistance. Our speaker today is Daniel Wager, who leads the Global Financial Crime Compliance Strategies for LexisNexis Risk Solutions. Daniel has over 23 years of experience in the financial crime compliance space, having worked in enforcement and investigative leadership roles with the U.S. government, in compliance executive roles with global institutions, as well as in the advisory and solutions provider spaces. It's with great pleasure I now turn this special session over to Daniel to begin. Daniel, take it away.
All right. Thank you very much, Chris. And thank you for everyone that's joined again at varying time zones and geographies around the world. We really appreciate your time. The goal today is to have a fairly broad-ranging discussion with some iterative Q&A that we may do as we progress, or definitely at the end of the session. We're going to allow time for that so that you can forward questions, so please make use of the question and answer portion. I'm very privileged to be able to speak to you today. As Chris mentioned, I lead Global Financial Crime Compliance Strategies for LexisNexis Risk Solutions. Our company is familiar probably to most folks on here. As I look through the long list of attendees, there's a lot of folks here that operate either as in our customer space or others who are in the industry that are familiar with our offerings and what we do. Today is not a product pitch. My goal today is to put out some ideas based on what we're seeing across the industry, what we're seeing from regulators, and having just returned from the FATF Private Sector Consultative Forum, where there was incredibly lively discussion of a range of topics on how to approach data and new technologies, as well as virtual assets, virtual currencies. We want to provide some of that feedback to you to get folks thinking about how to best approach their data within their enterprise from a 360-degree view. The goal in the industry is easy, is apparent to most folks who are operating in this space, that disparate data segments, conflicting data, incomplete data or incorrect data is an issue that is well familiar to everyone, I'm sure, on the call, not just because of the difficulties it presents in ongoing operations, the difficulties it presents to customer friction, but also in the problems it creates in the compliance environment. And given that we operate as one of the leading global providers to almost every major bank in the world with one or more of our solutions, we're able to see a lot of what's going on at the customer level and in their interactions with regulators. So I'll start off by a quick view of what we plan to discuss today. It's a very broad agenda, but we'll go over the regulatory landscape, discuss some individual data challenges that we've seen and that are obviously affecting the industry, and then talk about some strategies to manage these issues and control these issues. The regulatory environment, as it has played out over the past actually 20 years, has really been a roller coaster for most folks who have been involved in this space. Bear in mind, it's also been a roller coaster of change for the folks who are on the regulator side, as well as the enforcement side. And really, when you break it down, those are the key constituencies of the industry. It's the folks who examine us from a regulatory perspective, the folks who enforce upon us when they identify failures that are worthy of addressing from either a criminal or a civil judicial perspective, and then also internally from internal audit and other constituencies. But bear in mind that all of those are interrelated. And I'll go more into detail on this as we go forward, but just bear in mind that none of those things exist in a silo. It should come as no surprise to any of you that internal audit obviously reports to and speaks to regulators on a regular basis. The regulators interface with enforcement agencies within careful boundaries on an ongoing basis about issues they have found, failures of controls, data gaps, data inaccuracies, and then the reverse. When an enforcement case arises in any jurisdiction at this point, at some point that agency, as they progress their investigation, will typically interface with regulators to say, hey, there's an issue here that you're going to need to address, either contemporaneously with our investigation or longer term. So on the slide that we have up here, we wanted to highlight a few areas that are of concern. Obviously, the regulatory expectations, the regulations on which the regulators act, and in which the enforcement agencies predicate their cases in many cases, pertain to some but not all of your areas of practice. But bear in mind, I have to caveat that with regulators and enforcement agencies know few boundaries. And while a regulation may affect what appears to be a very specific subset of either your data or your control environment, when they dig in deep. And just to give a quick anecdote of how the industry has progressed in this space, and try to keep from just speaking to slide points too much. I'll give you an example. As my own career has evolved, I first became familiar with the concept of money laundering as a young member of the military in 1989 in Panama, when I was tasked to support an intel collection team that was looking for evidence of money laundering against Manuel Noriega. I had no idea what money laundering was at the time, but the direction to me was, don't worry, you don't need to know what it is, just look for bank records and then make a pile. Interestingly, fast forwarding 20 years from that, as I operated in the financial crime leadership space in global institutions, leading investigations and AML programs, we haven't evolved significantly in how data is collected, analyzed, shared. From that example I gave, we, as an industry, have made great leaps in technology, and some institutions and solutions providers in the industry are actually working to advance that paradigm quickly, meaning let's get a single view of the client, let's have a more holistic view of the client, let's merge our data sets. But every day, as we engage with our clients, we get feedback that regulators come in, they identify an issue, they do an expansive request for additional data, and inevitably they find additional points of conflicting data, conflicting outcomes based upon bad data, or control and monitoring or screening decisions based upon poor data. So that's really a foundation for what we're talking to today. Just keeping track of the changes and implementing controls is a difficult process. So we're hoping to add some value to that. I know that everyone that is in attendance today is progressing their knowledge in this space by staying engaged with the industry, speaking to peers, learning from one institution as they move to others, which is a very critical dynamic in the industry. But just keeping a pace with expectations and changes is extremely difficult. And regulators, the last point on this slide, have a very distinct advantage. When they come into your institutions, whether you are a regulated financial institution, a financial services regulated entity, an entity that is broadly regulated under a variety of jurisdictions and regimes, such as lawyers, accountants, and even places such as car dealers and others that have certain aspects of Bank Secrecy Act reporting in the U.S., not for suspicious activity, but for things as simple as Forms 8300 and others. When they are examined or enforced upon, regulators come in having heard from other banks, the people that rejected your payments, the people that asked for requests for information about shared clients and got back minimal results from your institution. They have the advantage of seeing suspicious activity from enforcement agencies that has been highlighted, where they've dug into a variety of data points which you may not be using right now. And I'll go into more detail on those, but right now, if one institution that you interface with has reported back that they have shared transactions with your entity, there's a great hazard that that other institution has been leveraging data points or better data, insight into global businesses, portability of phone information as people contact their institutions, digital attributes across hundreds of potential attributes to be collected, to come back and say, there's broad risk here, and it's all emanating from institution A, and that's you. That's a bad start to an exam, and you can be sure that their sample will include enough data to highlight those data deficiencies. And again, this dynamic is nothing that is unfamiliar to the folks on the call, I'm quite sure. So moving on, just to give a quick discussion and overview of the regulatory landscape. FATF, most folks track to FATF guidelines. FATF does drive discussion of regulatory standards. It's a key driver in almost every global regulatory regime. If we focus on the U.S., if you look at the FFIEC manual, which we have an upcoming slide on in a few moments, most of the elements of the FFIEC manual make their way through FinCEN and Treasury and OFAC and other elements, but they also key critically to FATF. So FATF's talking about a holistic approach to compliance and not just box checking. Don't look at a couple data points that you think are sufficient and make a decision, but look holistically at the data at your disposal, and therein is a problem. The question to ask is how much data is at your disposal. It's not uncommon for global financial institutions to have investigative staff or level 1 and 2 screening personnel keying into dozens of core systems, as well as external systems from providers, in order to gain a view of what the risk is. And that, again, goes back to the how have we progressed. There's been modest progress. There's some quick acceleration of progress in that space, but most folks and most institutions are still pulling things from different places and trying to align them. FATF's saying that's not going to work. Look holistically. Obviously, their encouragement is on focusing on effectiveness and efficiency. And those two things are tough to balance. We know there's cost compression and cost constraints in the industry. So how do you get to better effectiveness? And that's measured by quality of reporting, identification of risk before it goes outside your institution. But the key to doing that is having the right data and applying the right tools on top of it. They encourage the exploration of data sharing and obviously focusing on information safeguards and privacy, data privacy. But bear in mind, almost every jurisdiction, no matter how restrictive, has got provisions in place for sharing with affiliates in some cases, upward with parents in many cases. And then regulators themselves, to include FIUs, as you probably know, have the ability to share information with each other. So they're encouraging that approach. New compliance requirements, such as that which came out under the CDD rule and the proposals around beneficial ownership. Note that the U.S. continues to be faulted by FATF for its lack of beneficial ownership transparency. So until that is solved legislatively and politically in our country, the U.S. will continue to be a place where identifying beneficial ownership and conducting proper due diligence on entities that are corporate and global, as well as U.S., will be difficult. So that puts demands on you from the data side, from the investigative side, from the program management side. You have to do more work until those repositories are established, hopefully, at some point in the near term in response to legislation and proposed rulemaking. Regulators also issued in December of last year, the FFIEC, in conjunction with FinCEN, issued a joint statement encouraging innovation. And that statement on innovation was quite interesting. It created a lot of discussion in the industry. So when you look at that advisory, it's important to note that they say you should be innovating. We encourage you to innovate. There's also some very careful language in there that says identifying risks through innovation will not necessarily result in an identification of program deficiencies. It's a not necessarily clause that is giving some pause to the banking world, but clearly in conversations that I've had with enforcement agencies and regulators, their desire is to open that innovation channel. The UK, as well as a number of Asian jurisdictions, have aggressively pressed for sharing information and sandboxing, but the U.S. has what is the broadest information sharing protections in the world under Patriot Act Section 314B. And I shouldn't leave out 314A because they both provide the opportunity for sharing of information. There's an opportunity to innovate there. And I'll throw out one bit there, just to put a pointed example, because again, I don't want to talk only at a high level here. If you think about what your institution is doing, or the institutions you're advising, as we have a large number of advisory firms in attendance today as well, something as simple as the 314A list, which is published by FinCEN in the U.S., but also global institutions operating in the U.S. have access to that list. They receive that list. That list was updated years ago, 3 to 4 years ago now, with some critical points of data. And I'm going to ask, just to give thought right now, are you exploiting those data points? Until that time a few years ago, the 314A list only contained an agency representative point of contact on that list. And very subtly, several years ago, under Jen Chasky's guidance as FinCEN head at that point, they added a case agent point of contact to the list that is exposed to financial institutions. Now think about that for a moment. This is an opportunity for innovation, an opportunity for innovation sharing. It's an opportunity to exploit data more effectively to identify risk. In a case such as 1MDB, cases such as Russian laundromat, cases such as the FIFA and Odebrecht scandals, there are judicial actions in the U.S. where the name of an investigative agency case agent has been published. So when you realize that you have received either a subpoena or a 314A request on which maybe you filed a SAR after a comprehensive investigation, do you go back and look at the history of requests from that case agent? It's there for you. It's at your fingertips. Go back and look and say, this case agent, you can be assured, has only been working on that one case for several years. Are you exploiting it now to review the prior records that were requested, the information that was requested from that person, through the lens of corruption, broad-scale embezzlement or bribery, or even if it's a human trafficking case? It's a difficult data point to get to. It's something the industry is moving aggressively to provide you better tools to identify. But you should be doing this. You need to be leveraging these sort of triggers and data points internally. OFAC published just only a week ago a framework for OFAC compliance commitments. We've got a strong number of corporates on the phone today, non-regulated corporates who are either in or around the financial services space, but it doesn't matter because sanctions, whether promulgated by a foreign government or the U.S., in most cases apply globally to corporates. But if it's U.S. OFAC, if you do business in the U.S., you're a U.S. person or company, you're listed on a U.S. exchange, you transact in U.S. dollars, you're under OFAC and you can't violate. So they issued a framework, and it's really worth your read to go back and look and say, what do they deem to be a sufficient framework for OFAC compliance? And data and the quality of data reviewed is referenced overtly and subtly repeatedly in that document. So why good data is necessary? Why is good data necessary for compliance and true risk identification? We've hit on a number of the points. We're going to go into it more deeply now. Obviously, most folks on the phone know that enforcement activity has continued at a significant pace for AML, for sanctions, for program deficiencies, from a variety of regulatory entities at the federal level as well as the state level, with California and New York State DFS certainly at the fore of those efforts. This graphic shows that it's, it asks you if yours will be next. Well, some of you have already been enforced upon, and you know this. But this graphic is also somewhat misleading because the 1 in 5 actually touches an incredible number of mid-market and large banks disproportionately. But then it also touches the low end. So credit unions and money services businesses that operate on a smaller scale, and some big ones, have been enforced upon repeatedly. What the 4 that are in blue here, there's a large number of off-the-radar community banks, credit unions, and some institutions as well. Only 1 or 2 of the U.S. U.S. institutions in the top 20 by assets are not under some sort of enforcement action or just coming out of one. So moving on, the consequences, again, stating the obvious here in some ways, but hoping to highlight some new points for some folks to consider. The consequences that you have to message. If you don't know them, or if you do, let's assume you're very conscious of these points, these risks. This is part of your critical messaging upward as you compete for compliance dollars and operations dollars, as you compete for attention at the board level for continued attention to compliance control spend and even the person spend behind it. It leads obviously to inconsistent risk ratings. I hinted at it earlier, but if you're using a risk rating schema and calculation that relies upon data points that are very traditional, country, product, customer location, indexes from international organizations that rate transparency or corruption indices, that's great. But do you have dynamic interfaces to things like I mentioned earlier? When OFAC comes with a letter, when a subpoena comes that is of consequence, are you using that to trigger a delta or a review of your risk rating? If you've gotten to the point where you're automating those inputs, fantastic. That's outstanding. But I'm telling you right now, just to make you feel a little better, most institutions are producing responses to subpoenas without even understanding whether it's an important subpoena or it's not. Did the subpoena come to you from an IRS revenue officer or from a special agent? What's the section of federal law that is cited? Did it come to you from the Manhattan District Attorney's Office, and are you differentiating between their major economic crime section, who has been party and driving most of the sanctions, settlements, and monitorships for the past decade, or does it come from their general crime section and involves a $1,000 felony? You want to be able to differentiate between those two and treat them as different risk inputs to your customer risk rating and to your investigative processes. Obviously, having a non-unified program can lead to cease and desist orders and both public and non-public enforcement orders, fines, loss of business during the remediation process, and the tremendous spend that comes from remediation, and a decline in market value. And then the incalculables, the perception index. No one wants to be at an institution doing great work against tremendous headwind for cost compression or data systems, non-alignment, and be there when an enforcement action drops. The impact upon staff is almost incalculable. Everybody wants to be part of the cleanup team, but it's very hard to articulate that I've been there doing good things for 10 years. So the impact upon staff is also a tremendous impact. Moving on to the next slide here. Most of you know that your connections from your institution or your entity or the entities that you advise or service are ever increasing. You definitely have to think about the number of inputs coming in and the silos they create. Are people collecting different names, addresses, phone numbers, and the way that products are used across different areas? Is marketing different than financial crime? Is financial crime in your institution unified between fraud and AML? Is legal collecting information? Are your phone centers collecting information that is not populating into all of these areas? It goes towards that unified view of the client. I really hesitate to use the term single view of the client. I think we are a long way from that, but we're making strides. We have to continue to keep pushing for that single view. And here's some more detail on that. Those multiple relationships can obscure the risk you face every day. They may have their own relationships. They may have their own risk ratings or different business units. They may be populating with different outcomes. That's what your regulators and the enforcement agencies love to highlight. How could it be that your risk rating was medium, but you'd received dozens of subpoenas? Your relationship manager dismissed all the adverse media on his client, and no one in compliance acted upon it. Internal audit missed all those fails. And as a result, you continue to carry transactional or customer risk unaddressed. Not to mention, on the right-hand side here, the duplication of work that arises from all of these areas. So moving towards a more consistent 360-degree view of risk presented by a client, whether corporate or individual, is going to help prevent duplicate work and help protect you against regulatory and enforcement outcomes that you don't want. So a quick restatement here on this slide. As you look at this slide, it's just a restatement of what's in the FFIEC. I'm not going to go through it in depth, but note that there's not a lot of overt reference to data in here. But my question would be, how can you have effective customer due diligence if you have conflicting data about your customers' attributes? How can you have a good customer due diligence program if different outcomes and decision-making have come to light in different silos of your enterprise? So worth referencing that if you haven't gone through. One thing that's fun to do is actually go through the FFIEC and keyword for data. You can do it. They've got a decent query interface, and look at the places that data is referenced. You'll particularly see it come up in the guidelines on how to sample in exams. So moving on. Some of the challenges, I've highlighted a few of them here. I noticed one of our bullets says, some of them have wrapped here, and I think that's just in the translation of the slides to the form we brought it in. But just the data challenges present to different areas. General counsel's office, the way they see risk and how things escalate to them is a completely different environment in most institutions than the line functions of investigations. Again, I asked, is fraud and broader FCC to include AML, anti-bribery and corruption and sanctions, unified in your institution? And if not, are you sharing data effectively across those? One example that's frequently cited in there is that fraud has advanced far beyond FCC at almost every global institution in its ability to ingest data points, digital identity data points. That was referenced specifically in FinCEN and the joint FFIEC guidance in December. Digital identity intelligence, regularly used in the fraud space to identify fraud risk, and it often stops right there. So work to break down that barrier so that information is accessible by your FCC investigators and is shared between those entities. Wealth managers as just an example of customer-facing entities. Cybersecurity, worth questioning, is cybersecurity in your entity focused solely upon preventing DDoS attacks and intrusions, or do they interface with their peers in investigations and other areas to identify data points that can be leveraged by both, and improvements to the control environment that come from findings in both areas? Business operations obviously deeply challenged, and customer support also. Moving ahead, the impact of this, we've already talked to this, but I'm going to give a couple of quick data points, pointed data sets on this. No industry or sector is immune from the effect of data, poor quality data, and it causes tremendous cost and inefficiency. A Harvard Business Review study cited that on average 47% of newly created data records have at least one critical error. Now think about that in the compliance environment for a moment. If that critical error is a transposition of a social security number, a miscuing of a name, the transposition of a name because it is a compound surname that is common in certain groups and countries around the world. The same study found that only 3% of data in those organizations surveyed was rated acceptable using the most liberal of data quality standards and scores. That's a pretty low number. Now, thankfully, most institutions aren't rated in this way by regulators, but again, they look for the exceptions to poke holes in questioning your control environment and effectiveness. Some other areas that I already hinted to, but poor data causes customer friction, bad decisions, and reputational risk. But customer friction for a second, how many times do you hear examples about customers being contacted through RFI processes via email or phone to get data which is available in some other place in the bank, and the customer is more than happy to highlight that to you? How many times am I going to provide this to you? It hasn't changed. Don't you have some way to verify this without coming to me? And the key is that there are. There's ways to identify those opportunities for refresh, to improve data quality, to fill in pre-Patriot Act records that are still lingering around your institution. Or my favorite example is how many of your institutions, or those that you advise, have accumulated by acquisition or aggregation business lines and product lines that are filled with data inconsistency or inaccuracies. One of my favorite examples is multiple global banks that I've seen on data migration. Someone during the integration thought it was okay to eliminate a date of birth field from records because they didn't have an obligation to collect when that business was formed. So they deleted the whole set. Think about what that does to your screening and your monitoring, your customer due diligence. So that customer friction points to a huge underlying problem of dirty data across your enterprise. Moving ahead here, this is a workflow that all of you are very familiar with, so I'm going to move very quickly through this slide. one thing that does kind of plague me is the frequent use of KYC to cover all these areas. You'll see we've done it on this slide in deference to the industry's preference. Even regulators often use KYC as a broad term to include all of these subordinate elements here. And you should review these when the information is shared later, but material you're well familiar with. The pillars haven't changed except for the addition of the fifth with ongoing CDD. And highlighting that one for just 1 second, that rule, the customer due diligence rules that are in effect, the question is, how do you conduct your ongoing CDD? Is it manual? Is it done by RFI to a customer, and how can you do it better? Can customer due diligence on an ongoing basis include data that is filled from external sources with high degrees of reliability? If you're going out and questioning, to use a recent volatile example, if you have to go out every time to ask a customer about citizenship, which, by the way, is a protected area, you're expected, it's in the FFIEC, you're expected to understand citizenship, nationality, and residence of a customer to best assess the risk. But gosh, you don't want to have to go back out to a vast set of customers and ask them to send you copies of passports. It's going to result in bad news, and there's better routes. There are solutions providers, including ourselves, who are able to fill those data elements without intrusive and repetitive customer iterations. So a slide that's familiar because it looks similar to the last one, that single customer view across the center, that's still aspirational. The single view of the customer will be aspirational for some time, but we've got to keep moving towards it. So all those inputs across the top you've seen before. Across the bottom are some of the external inputs that should be included in an external customer view. I've hinted at risk triggers ranging from subpoena to law enforcement inquiries, rejects of payments from other banks where they cite potential sanctions risk or other aspects. Adverse media, most of you are very familiar with that, and external data attributes, again, we've covered quite well, but digital identity, worth a moment. Digital identity is the second red circle at the bottom. Extraordinary underutilization of digital identity intelligence as encouraged by the FFIEC guidance of December. It is not being leveraged in the way that it can. Fraud is way out ahead of most other areas. Those entities that have combined fraud and FCC have seen tremendous lift and will continue to see tremendous lift in this area. But to be honest with you, a lot of entities on the financial crime, sanctions, anti-bribery and corruption, and core FCC non-fraud areas are limiting themselves still to device and IP. And it's just the tip of the iceberg of the digital identity intelligence attributes that can be leveraged to give you a better view of customer risk. Moving ahead. I don't like this. This is a bit of a doomsday slide. The odds are stacked against you. Well, the key is how to help. The odds are stacked against you. The siloed data and the deficient controls that they contribute to or exacerbate are certainly something that's going to hamstring you as you move to make your program better. So how do you mitigate risk without having exorbitant expense? Surveys of the industry, and this is citing an Accenture survey. There are many other surveys out there, but compliance costs soaring more than 50% in just 3 years in a survey that took place in 2015. That trend has continued despite drives for cost compression. A big driver in that, obviously, look-backs and remediation. But what's driving look-backs and remediation? It's often failures of controls riding atop bad data. So moving ahead, as we look at this one here, take a look at an example here that kind of lays out how duplicate processes work. If you acquire 10 customers and the onboarding costs are $20 each, which is a very conservative cost structure, your acquisition costs running around $200,000. If each of them, 20% of them, maintains an additional relationship with your FI, that cost becomes compounded. You duplicate expenses to the tune of $40K in this very simplistic example. It duplicates it not just in the core system, but it hits your marketing, customer monitoring, record keeping, risk rating scorecards, and other areas. So the cost exponentially increases with your failure to align data, going back to that single view aspiration that is making great progress again. You don't want to alienate customers. This is the point I made a few minutes ago. You have to strike a balance between what the regulators expect you to know and how the customers feel they're being treated when you go out and touch them. So one thing you should keep in mind is, are there innovative ways that we can refresh using external data? There's a lot of really good data providers. I'm very proud of the offerings we have in this space. But this is a customer question that comes up all the time. I've been with you for years. I've given you this data. Don't you know that question? Don't you know the answer to that question? I provided it to somebody else in your institution not a week ago. It's a highly embarrassing outcome. So you, everyone on the phone, no matter what section you work in, are going to bear the burden and be called, whether directly in interface with regulators and enforcement agencies or just the pressure downward, depending on where you sit. You're going to have all this burden on your back, of those things we talked about earlier: brand damage, legal remediation costs, the peers or colleagues' impressions, and shareholder loss in value, the other areas highlighted here. It's all on your back. Don't think you can escape it. So what if you could do things to actually stay ahead of risk and stay ahead of evolving expectations? Well, obviously, a near-term goal should be to identify and consolidate data from your different relationships and your different data silos from across your business units and geographies. And that's a very simple statement in a very complex environment. But again, don't be daunted by someone's unsupported statement that we can't share data. We can't look at data from this jurisdiction. Explore that to the extent that you can, and you should have some sort of data aggregation and single workflow process underway. Strengthen your oversight and your controls. You'll get efficiencies out of that, and the goal then is to not let those efficiencies go back out of the operational risk and compliance environments. You want to recapture those to be able to spend on high-quality people and systems to better identify risk, dissatisfaction of regulators, to avoid hitting the news. And overall, one of the biggest things is improving the customer experience, because you'll hear it as something that's decried often in banking circles at very high levels. But all these demands make people not like banks, right? FinTech and RegTech have done a great job of innovating in this space. The industry as a whole is seizing upon those concepts that FinTechs and RegTechs have put forward to say, how do we do this more innovatively and create a better customer experience? It's a good challenge, and it actually came out very much during FATF discussions. There was an absolute tension at the FATF Private Sector Consultative Forum between FinTech and RegTech, particularly on the crypto and virtual asset side, because that's what the focus was on for the sessions. But they and the regulators and the big banks, there was a very distinct disconnect where folks said, great, I'll get all this data from you from the RegTech side, but we're already reporting suspicious activity. We're doing it through completely different ways. There's a lesson to be learned for them for understanding foundational elements as, to drive transparency into who a customer is, while still maintaining inclusion goals, while still reducing customer friction. But the banks have a lot to learn and how to do it more effectively. And that's where the learning curve needs to bring those groups together. Moving ahead, importance. There's studies around this, but 40% of businesses initiatives fail to meet the intended benefits due to poor data quality. This is something we see with our customers all the time. We've, in fact, over the last 2 years, initiated a concerted effort to make sure that as we engage with customers in deployments, and we're not unique in this, but I think we're very good in this. But when we go out to customers and say, we're going to help you roll out a new system, a new protocol, new sets of data, the common answer is, oh gosh, we've tried this before, and we end up with horrific results, huge backlogs and inconsistencies. Well, maybe the first step before you do that is to clean up your data, align your data, improve your data quality, because that is going to directly impact your screening, monitoring, due diligence iterations, and the quality of their outcomes. So we've got some questions queuing up. I'll get to them in just a couple minutes here. I'm watching time closely here to see how we're progressing, but just another slide on how it impacts your organization. As you look at this, keeping customer portfolios that are separate, it's costly. It's redundancy. It's inconsistency. We've talked about that at length. The unconsolidated view is incredibly risky. It results in unaligned risk assessments. It results in unaligned decision outcomes as to reporting a suspicious activity or maintaining a customer relationship. And unreliable data and disparities in customer records across your enterprise drive inefficiency. I would suggest that you still, if you don't have this message, a lot of institutions have this messaging going up to their boards as they fight for budget dollars and new systems. But these are great talking points to say, folks, I'm not just going to benefit compliance. I'm going to benefit fraud. I'm going to benefit marketing. I'm going to benefit the bank's reputation broadly. And we're going to save money and better reallocate those resources. And at the bottom, again, coming back to it, it really comes down to friction and expense for the customer. Relying on a customer to notify you of changes in their data shouldn't be happening at any of your institutions. Hopefully every one of you has a system that monitors for customer data delta changes on key data elements, the emergence of adverse media, the emergence of a change in their address. But more expansively, you should be watching for how they transact and present digitally. They've always been a U.S. customer, but now they're only coming through this foreign VPN. I would ask you right now to think, as you assess customer risk, you get ready to speak to a regulator about how good your program is, are you watching to see if that customer who's always been and comfortably operating in a certain way in your state and not tripping any of your transaction monitoring rules environments, have they changed completely in the way they digitally present and are trying to hide their settings on their devices? Are they operating from risky jurisdictions after you pierce the proxy or VPN they're using to hide where they are? Are you doing that? Have you even given thought to that? Because fraud's doing it. Fraud's been doing it for years. So cross that boundary. The survey here identified $14.2 million in poor data quality. I would suggest to you that while Gartner did a great job with that survey, they used very conservative and empirical assessment standards to do that. That number may be vastly higher across the industry. So moving on again, looking at client data initiatives. The challenge to you is to improve your data quality, to resolve those silos, to reduce your operational risk resulting from them. Identify your gaps and do it before the regulators point them out to you in an exam after they've sampled you. If your challenge is limited resources, look for better solutions. Look for ways to automate processes to get people thinking and not typing, get people thinking and deciding and not keying, and get people thinking and deciding and not iterating with customers. The opportunity is all these things drive towards a more unified view of the client, ultimately towards a single view in the aspirational sense. Look to leverage companies like ourselves that offer best-in-class linking technology. Just speaking selfishly for a moment, we utilize a process that is called LexID, and it's based on our name, Lexis. We have a Lex Digital ID that now is also used to identify digital identities not definitively tied, but linked to physical identifiers. And there's now a crossover between the two. That kind of linking to say, this person is the same one as this, and this digital identity is the same person, is something you should be aspiring to do through a competent solutions provider. And I say that because, let me just give you a quick example. Conscious of time here, I'm going to try to say it very quickly, but imagine if your customer due diligence process and list screening and watch list screening processes are result in repeatedly rescreening every customer who opens a new account. That's required. You got to do it. But that shouldn't be your key trigger for reexamination of that. How quickly could you resolve a customer due diligence review that's triggered a list concern, either an internal watch list or an external one? If you can say, gosh, their social security number is transposed, their name has a slight variation, or they've now got a different address, I've got to dig in and figure out if they're the same. What if a reassuring point to that was that digitally, as they signed up for an online account with you, they presented a digital attribute of hundreds of digital attributes that would be impossible to mimic by a fraudster. And they're doing it the same way they've always done it with you for 8 years in their retail account, through the online retail portal. Great reassurance that that customer is the same, and you've already ruled them out as the one on your watch list. This could be a way to accelerate. So moving ahead again, we have a case study here. I'm not going to go into a tremendous amount of detail. I want to leave time for Q&A. So looking over this real quickly, you can kind of ingest it, and you can refer to the materials later. But, looking at LexID, which I referenced a few minutes ago, 183 million records input from over 20 source systems with a 99% match confidence rate, resulting in 94 million unique identities, with 3% of them deceased. And what we're pointing out here is that when we take this vast record set of public records and deduplicate it with a high degree of match confidence, also not a black box, the match confidence that you can point to for your regulators and identify those ways it was matched. But those unique identities just cut in half the number of entities that you may be dealing with, depending on how many are in your institution, or you plan to onboard. And what are you going to do with the deceased ones? Wouldn't you like to know that right up front? The data sample on the right is also very compelling. Just to quickly highlight a few points out of it, 460,000 out of a 20 million record random sample, 460,000 SSNs were invalid and 375,000 were completely incorrect, meaning they didn't actually match the person claimed. Missing dates of birth, others incorrect. And then the vast record set that we leverage and others leverage shows that the current address that you had was not the current one. Those are things that you can update in an automated fashion in a workflow with less people time, and that's the goal. Moving ahead. Thankfully, our slide numbers on the bottom are not correct. We're not only on slide 6. And I'm going to get ready to move to Q&A in just a moment here. This is another case study, and just to kind of show it to you so you can review it later, the top shows you the number of identities, the relationship seen as a Lex ID, a unique, reliable identifier, and the number of associated records in that. You can see how it's, the records are seen once in the file at a high number, and it increases as you go down. So there are identities in here with a huge number of records that were repeated across an enterprise that could have been immediately deduplicated in a single motion, a batch data motion that is quite impressive in its result. And it has regulatory survivability. It's not black box. The parameters that are used are easily explainable, and it has passed intensive regulatory review at some of the world's largest banks again and again. Another case study here showing actual lift, putting a dollar value around it. The dollars expended, not giving away price points on this, are vastly below the financial benefit that's outlined in the first bullet there, but it spells out many of the same benefits: reduced data spend, reducing redundant processes, reducing silos, benefiting many segments of a business. The goals, obviously laid out there on the left: compliance, customer care, marketing, collections. I haven't raised the collections use case, but it's a highly regulated space that's reliant upon accurate data. Huge issues if you're going out to contact customers at inaccurate phone numbers, addresses, other data points. You end up contacting the wrong customer. What if you have duplicate silos across, and you have records of that same customer, and they're in good standing in one place and collections in another? Don't you want to assess that before you move something to collections? That non-alignment has significant impacts in just the specific collections market space. The other benefits are spelled out here. In the interest of time, I'm going to move ahead. A couple of other points: marketing and customer management. It's a space that we in compliance often shy from because of the fears of stepping into marketing. But bear in mind, improvements to core data systems that benefit compliance also benefit customer management and marketing. And there's nothing wrong with that. As long as it progresses across the properly delineated use cases and data use permissions, it can flow directly into the marketing space as long as you have the right customer permissions. And most of your institutions are really on board with that. Annual notifications, permissioned contacts, et cetera. Wouldn't you rather have a higher effective rate of contact and below it a more effective rate of collections because your data is accurate on phone number, name, address, et cetera? Moving ahead, just to summarize some of the benefits of the 360 view, just to restate the ones I've already said very quickly: enhancing the client experience, critical goal, usually put at the top by most institutions, but closely behind it, improving the operational experience and efficiency, the cost gain and operational people time that it brings. It obviously brings regulatory compliance and consistency. It delivers high-quality data, giving better risk decisions. That flows also up to number 2. It generates business value immediately and very significantly in the long term. And it allows organizations to more effectively implement change. Think about it right now. When's the last time you tried to roll out a new tool in whatever segment you work in? What were the obstructions? Well, most frequently we hear it was data. So getting that data cleaned, aligned, and accurate usually will allow you to change in response to regulatory and enforcement expectations, or even your own internal bank's expectations around cost and people time. So our time is 8 minutes left, giving you a few key takeaways to think about as we get ready to open up some Q&A. Know where your data is located. This seems like a no-brainer, but it's amazing how many times when you engage one segment of a business looking for a solution, they, during a process of iterations with us or other solutions providers, find out they have data all over the place that they could access or leverage or that needs cleaning up. Know where that data is and know which data sets are bad. You should already have identified those bad data sets to your regulators and have improvement plans in place. Don't sit there and let them ride. And those improvement plans should leverage outside resources. You cannot go to tens of thousands of customers to refresh data points and expect to have good public image or effective use of resources. Cleaning up and maintain your data, it's an obvious one. Optimize your data modifying process to ensure accuracy and avoid duplication. What that means is, do you have a process and platform right now to make sure that when an investigation occurs and it refreshes data points on a customer, does that flow out to everyone? Do you need to have a relationship manager tie up key relationship development time by going out to a customer when just a week before somebody in an investigative function or a client screening function has asked that customer for those same bits of information? And understand the interaction of your data with your clients' your compliance controls and processes. You understand what degraded quality dates of birth and addresses, countries of residence and citizenship do to all of your compliance processes, from customer risk to screening and monitoring. So that's the summary. Leaving now approximately 6 minutes for questions. We're going to go ahead and pop up on the screen a poll question. You can just look at this while we start to entertain questions. Looking now at some of the questions that have come up. If you look at this slide, once you click on this response here, don't worry, your response will not publish to all the attendees on the webinar. They will not see your response. So if you are asking for a contact, no one's going to see it. It comes back to us, and these results are not going out for publication. So looking at one of the first questions that's come up, this comes from a financial institution. Is the data we were referring to in the context of this discussion largely AML related? Names, dates of birth, occupations, and identification. Excellent question. But I would say think expansively. As I've talked about, it goes to marketing, it goes to frontline operations and customer-facing contacts, interfacing with customers. It's very embarrassing when a relationship manager has to ask for a copy of passports. It's an unnecessary thing, but it's a necessary burden at times, but can you do things to actually help him not do that and hurt his relationship? So I think this one has been well covered. A follow-up question. Our company has both business data and consumer data. Can LexisNexis resolutions help with both? Of course. Everything I'm talking about here is customer, individual, as well as business data, and know that line is blurred in the requirements around the CDD rule, as well as proposed beneficial ownership rules. You have to know who's behind the businesses. So they're deeply intertwined, and the data lift you can get applies to both. We're actually seeing a whole bunch of questions popping in now. We had a technical question on saving information. We'll make sure to provide an avenue for everyone who hasn't been screen catching to get access to these materials. Another question we asked, does this process impact a customer's credit report in any way? Well, I'm going to assume that this process that is asked is improving data, aligning a single view of the customer. This is a very important question, and I'll respond to it. This comes from from a person in the financial institution space. No, this does not impact a customer's credit report because, as I pointed out, the rules for data usage are aligned to specific use cases and FCRA applicability. It's very important that in your institution, as you move towards a more single view of the client, and we work with clients all the time to ensure they understand these lanes and create the right partitions and permissions. But in the FCC space, things like liens and judgments and bankruptcies have a much longer life than they ever will have in collections. So as you move towards this unified view, you have to ensure that they're taken into account for the risk they present within accepted use cases like fraud and AML, but that they're partitioned and excluded from those places where they can't be used, like credit decisioning. Old bankruptcies can't be used. Old liens and judgments have actually been removed from most credit headers, but not ours. We provide liens and judgments still out across the industry, but they are defined for a very particular use case, and it's up to your institution to put the right controls in place around it. Down to just a couple minutes here. We had a question about training for new users and new people in the compliance area. Well, there's an expansive amount of training available through industry associations, but also through solutions providers such as ourselves. If these concepts resonate with your entity and enterprise, that they may provide value to you, much of what we do as far as beginning a sales motion is not selling something without the customer understanding it. You have to make sure they understand it, and that starts with education. So feel free to reach out to us and come back to us with a request. You can use the request pane for the poll, or you can contact us directly. We'll be glad to set up that. And there's also, as I said, a wide-ranging number of resources available, not the least of which is ACAMS and other industry associations. I have to thank ACAMS for their assistance in putting out information on our webinar today. They're also a fantastic resource. Another question that came in, let me look at the next one here. They're actually coming in faster than we can even prioritize them. So what advice or offerings are there in view of automated data collection platforms to mitigate incompleteness on the insight into beneficial ownership in the U.S. in view of the changes that FinCEN has made in the definition of control? Well, very interesting question. So there are available to you from us and other providers, broad sets of data across different risk areas, generalized information about business for business risk purposes, particularized information about businesses and ownership structures in places like sanctions and sanctions ownership and control, adverse media, where we have an extraordinarily carefully curated and editorially brought to high editorial standards, a breadth of collection in our World Compliance Database that focuses on linking people to particular records that relate to adverse media, enforcement actions, license revocations, et cetera. So there are definitely resources available in this space. And with that, we've hit the top of the hour. We're going to go ahead and turn it back over. We'll be glad to entertain additional questions from anyone. You can send them in to Lexis directly, and you can also reach out to us. If you put in your information in the poll here, we will be in contact with you if you have questions for follow-up. So, Chris, back to you at the top of the hour. When past now.
All right. Thank you, Daniel, for a great presentation. We are so pleased that you were able to attend today's webinar and hope that you found it valuable. We would be delighted to continue this conversation with you at your convenience. And if you'd like a LexisNexis Risk Solutions representative to contact you, please indicate when by clicking your selection on the screen. Thank you for participating and sending in your questions. Once again, if we did not have time for your question, we will follow up with you directly so that you can get an answer. This presentation and webinar recording will be distributed to all registrants. And again, we'd like to thank you for joining us, and we hope you enjoy the rest of your day.